Hey everyone, this is George, head and founder of Pause Fest and Awards, and you tune into Breakthrough Sessions 2024. We're all about the clever ideas that push boundaries, and for the next couple of months, well, maybe just a month left, we're bringing you some of the sharpest minds in the business to talk about what's happening right now. Every Friday at 1 p.m. from September 6th to October 25th, we're live for 30 minutes, just enough time to give you some serious insights without pulling you away from your busy day. So let's dive in, get inspired, and most of all, let's break through together. Today's session is about founder finance, balancing business growth with personal wealth. You will uncover innovative strategies for founders to effectively manage personal and business finances, ensuring sustainable growth and financial security beyond the elusive exit. Our speakers today, we have Adrian Stone, VC investor, founder, chairman, and CEO of AngelCube. Adrian is a serial founder, angel investor, and aspiring personal finance author. Welcome, Adrian. Aprill Enright, Alan, co-founder of CEO, Tractor Ventures. Uh, Aprill is all that. Plus, she is a weekend artist. I didn't know that, and that's awesome. Welcome, Aprill. And Victoria Beal, founder of Submarine. Victoria is a co-founder of Submarine, the flexible commerce experience platform for Shopify Plus retailers, and a passionate advocate for diversity, equality, and inclusion in Australian tech. Welcome, Victoria.
Thank you.
Well, I'm going to just dive into questions. Thank you for joining us on Friday. It's end of the week. It's 1 p.m., half day, and we have 30 minutes to talk about founder finance. Since you are the founder, I wanted to start with you. And well, there's a lot to talk on this topic, but let's start here. Should founders be more transparent about their personal financial situation with their team to potentially foster healthier culture around the money and their risk within their startups? What's your opinion about the personal financial transparency there?
I love this question because my opinion has actually changed over the last 18 months. I used to be of the opinion that, um, it was our decision to start a business. It was our decision to employ people, and that, they don't, because it's a startup, they didn't deserve to have more financial responsibility than if they worked in any other business. You should still always be conscious of expense and bottom line, no matter where you work. That was my opinion. I've now done a complete flip and think that it is vitally important that the team that you surround yourself with understand what is at stake for you as a person. If you're going to be a really empathetic and people first leader, I think it's important that they understand that, because it is always going to be a driving force behind the decisions that you make in the business. You've got everything on the line. And particularly for my co-founder is also my husband, and we have two children. And I think it's really important that they understand that we're not coming home and putting gold flakes on our cereal, that it's actually, we're the ones that sacrifice first. We're the ones that, when we're making decisions for the business, we're the ones that are usually going without. And I think that doesn't need to be a burden, or it doesn't need to make them feel bad or guilty about that. But I think it's just a reminder that, we really believe in what we're building. We really believe in putting you first. That's why you work here. That's why we chose to hire you, is because you fit in with our ethos and our values. And if it is a good fit, then they'll appreciate hearing that, and they'll appreciate learning from that personal experience. And it's also kind of change management 101, right? Is to get buy-in and to bring people along on that journey. And the journey is not just about the product; it's about the people behind the business as well. So long story short, I used to be like, oh, it's none of their problem, don't bother them with it. And now I'm like, actually do bother them with it, because
Mm.
they're there to support you as well. If they're your colleagues and they believe in what you're building, then they'll want to know what's going on for you.
Well, you would hope so, because working, well, I used to work in an agency, and working in corporate is like, well, I don't kind of care sort of about these things. It should be there, it should be sort of happening. I don't have to worry about those. But working in startup is very different. in lots of ways. And so being transparent around that, it gives them just a little bit more transparency around how the business is functioning and I guess expectations, and just to have that sort of openness on both ends, I suppose.
Yeah, and I think, empathy is at the core of everything that, that I do in the workplace is about. And I want it to come both ways. If I'm demonstrating it, I want to be able to be vulnerable the same way that I expect, the team to be vulnerable and honest with me. So I need to be able to demonstrate that as well. And I think the reason I didn't want to do that for a long time was, was ego, or was, me being a bit prideful maybe, and not wanting to show them that we weren't, cashed up. But I think once I realized that what was stopping me from sharing it, it really unlocked that next level in leadership for me as well.
Thanks. And maybe it's also like, I guess the leadership structure, maybe it's now more flat as opposed to pyramid, of where we'll be the bosses and you're the part of the team. And now it's like, well, we are all together and it's all sort of shared across. And there's something that I would really also love to ask you maybe later on, and that it's around sort of a family business, or having a co-founder being your partner, and how does that work within this whole thing. But maybe I'll ask another question to Aprill, and going a little bit more about capital management as a founder at funder. How do you recommend founders think about the choices that make with the capital?
Yeah, so there's a few options founders have. There's the one everyone talks about in startup land, of course, which is venture capital funding, which is, equity, and you're selling a percentage of your future earnings with that. Maybe you're allocating a board seat, probably you're allocating a board seat and some control. But ideally you've chosen a good equity partner who you can rely on when things get a bit skinny, and you need some support, like whether that's a bit of emotional support or some sort of growth advice or something else. So there's pros and cons to equity, just like there's pros and cons to debt finance. And the thing with non-dilutive debt is the cost of that capital is coming every month in the form of interest. But your future earnings are all yours in that scenario, and you've still retained control. And there's a hybrid model as well. You can have a bit of both. So, I mean, you've got to think about what your goals are for the business, and how to balance that with the lifestyle that will go alongside that. Because the pace may change depending on which type of funding you take. So it's about educating yourself and being realistic about your balance sheet and your runway. When you take debt, you've got to be able to sustain the cash flow, of course, to successfully make that debt work for you. And if you are going for a hybrid capital model, you've always got to operate at two speeds, because when you're talking to VCs, you've got to be very optimistic and talking it up a lot to be able to get that interest and some competition in investing in you. But when you're working with debt, you've got to be a lot more conservative. You've got to understand what your operating costs really are and what your runway really is, and
More
it's
realistic.
yeah, that's right. So really, you've got to operate at a couple of different levels, and that can be hard to do. Yeah.
Yeah, yeah. Thanks. So that's more about, I guess, funding choices, and being very understanding of what you need and why you taking on that, and then kind
Mm.
of seeing how you use it up. Um, Adrian, you're next in line. I wanted to talk to you a little bit, and maybe this is jumping to the end of the cycle of the startup journey. The big thing we talk about, the exits. How do you ensure the financial security if the exit never happens, or doesn't meet expectations? What's your experience around that? We all talk about exits, but not everyone it doesn't come for everybody, or it comes in different sort of shapes and forms.
Yeah, I agree. And I've always said there's two types of startups. There's what I call the high growth startups, where the founders, for whatever reason, they're passionate. They're trying to, build a product without any thought of money at all. Or there's the founders who are chasing big money and, want the huge exit at the end. And, the stats say it won't happen, but, for founders, it might happen if you try 3 or 4 times. So, number one, I think if you're in a high growth startup that's take on venture capital and you're going to go through those rounds, plan on failing if you're going to fail pretty quickly so you can have another go. That's your best shot at financial security down the track. High risk, high reward. But for the bulk of the rest, most businesses, most startups, most bootstrap startups, agencies, all sorts of businesses are looking at the idea of the business becoming some sort of cash cow either now or in the future. And the first thing I would say to founders is you have to, number one, pay yourself a living wage while you're in the business. So that's a conversation. If you take on investment, that's a conversation you have to have with your investors. I must admit, early days as an angel investor, I was of the view that founders, should take the least amount possible to keep them, happy. I'm now of the view generally that if you're a founder in any position in your own startup, be it, you're the CTO, you're the CEO, you're whatever stage, whatever job you take as the job, increases that you should take, a salary that's, plus or minus, 10, 20% of going rate. Certainly you're not going to be paid, what an executive is being paid at a Fortune 500 company, but certainly what a small business exec. That's number one. So if you, and let me give you a story around this. So this is why this whole area is so important to me. I can't remember if I'd sold my business yet or not. So, if I was cashed up or if I was still, running my business. But I was in the USA. I was certainly paying myself a living wage there for various reasons. And I had a conversation with a friend of mine, and he told me about a friend of his, and the numbers are big because this is America. Everything's bigger in America. And he said he's got a friend who's got a very successful business. I didn't know what it was. And I asked him what his strategy in running the business was. He said, it was very simple. His company was making $20 million a year effectively, on the bottom line profit. And his strategy was to give 1/3 to Uncle Sam, which means roughly 1/3 went in taxes. So that's $7 million. He would reinvest in the business 1/3, another 7 million. And that left him 7 million that he could freely spend as much as he liked. And I thought that was just a brilliant strategy for any sort of business. And then I sat down later on and I thought to myself, hey, that's actually crazy. He's relying on complete luck that business will be around next year. Because let's face it, $7 million is a lot of money. But if Elton John could go broke spending $100 million a year, anybody can go broke spending $7 million a year. One private jet and you're done, right? So, the amount of money is irrelevant. You can spend it. So what I sort of came to realize, and this goes right back to your question, is I think the first two parts are 100% correct. 1/3 for taxes, roughly. Well, 1/3 to reinvest in the business. This is if you've got a bootstrap, profitable business of any amount, and you're paying yourself that living wage. That's number one. In that business, of that 7 million, he should have taken about $250,000 out to pay himself a living wage. That's his salary, $250,000. Then, as a founder, he should take the other $675,000 and shove it in investments outside the business. So now he's got roughly $7 million in investments. And let's say he puts that into, a stock fund like Warren Buffett would recommend across America. That would give you about 9% per year reliably over 30 years, and 4% for inflation. So that gives him 5% of that 7 million. He can reliably add to his salary, whatever 5% of 7 million. That's another $350,000. So I would say in year one, he can reliably spend $500,000 salary. That's amazing. In year two, invest another 7 million and up his salary by another $350K. And after 5 or 10 years, yes, he could probably pay himself $7 million no matter what happens to his business. So to answer your question simply, treat your business like an investment, pay yourself a salary, and then invest outside the business any money that you can get from the business and live off the proceeds of that as any other investor would do. Read Rich Dad, Poor Dad, read all those books, and just separate your personal life from your business life.
That's a very interesting story. I really learned a lot about that. But what happened? So this guy had luck or just had a good business that he could make that much money. But what about those that, you know, mostly spend on taxes and running the business and actually don't have the additional 7 million to just invest in other things? Do you have any sort of advice there?
Yeah, look, it's the same formula. So let's say you've got a startup and maybe you've raised a little bit of money, maybe you've just passed break-even points and you're paying yourself 80K a year. Okay, so now your business is generating 80K profit. It's not generating any profit though unless you pay yourself that 80K as a salary. So now you've got a break-even business. And from 80K, congratulations, you've just taken your first year in the job earning $80,000. What does anybody else on the planet do if they've earned $80,000? You spend 70 grand and you save 10 grand. Well, someone goes in super anyway, so you're forced to do that. So I would say if you read any personal finance book on top of your super, save 10 to 15% of that and put it in outside investments. And if your business doesn't last another year, sorry, I can't help you. You're broke. You just got to start again. But if your business does that next year and the year after and the year after, congratulations, your 80K might become 85K, 100K, 120K. Just no matter what your business profit is, whether it skyrockets high or low, as long as it doesn't drop and go to zero, then you start again. You're just a salaried person giving yourself pay rises and investing any excess money, and you can live off a percentage, a small percentage, like 4 or 5% of that excess money that you have in the bank. And that's it for any size business at any stage.
Yeah. Okay. That's a lot. That's a lot to a lot of founders are not technical and not financial. And that's a completely other sort of side of maybe conversation. But I want to talk a little bit about mental health versus financial health. And we're talking about finances and all these think living life of founder is up and down every day. And yeah, mental health is a big thing. And often founders sacrifice personal well-being for financial success. I know that for myself. Victoria, I would love to ask you, how do you ensure that the drive for financial security and business growth doesn't come at the cost of your mental and emotional health? I'm not sure if you've been in those situations as a founder. I would suspect you would. It happens to everybody. You can't avoid it.
A few times a year for the last 5 years, I reckon. Yeah, I think it's a changing beast. I think for us, it has been, I mean, I can only speak to having a co-founder who I also live with and raise children with. And I think that adds an additional layer of complexity when it comes to caring for yourself, because both of you are putting all your energy into the business. Both of you are putting all your energy into your children. And then maybe you don't have a lot of energy left for yourself or the other person. So there's been a lot of layers to us managing that well-being and mental health over the last few years. I think for us, it is always bringing it back to what is it for? What would we use the money for? And if what we would use the money for is, family holidays or, freedom to upgrade our living situation, and all of that comes back to the fact that our family is still a healthy, cohesive unit when we achieve that financial success, right? So it's always remembering why we're doing it and being able to cut the fat and identify, is what we're doing right now tonight, instead of having dinner together, instead of planning a holiday or doing whatever we're doing, is what we're doing right now going to move the needle financially for us in the business? Is it going to work towards closing a deal? Is it going to work towards cutting expenses or saving money? And if it's not moving the needle for us financially in the business, why are we sacrificing ourselves right now to do this work? And sometimes you can justify it, and sometimes you go, do you know what? I'm just so anxious, feeling like I'm not working in the business because I feel like I need to be working. Then we need to unpack that. And it's maybe, okay, do an hour and then watch an hour of telly. Maybe it's just really cutting it down to a per day basis, or maybe it's looking at, the rest of the year and saying, look, the way we're operating is not working for us. It's not working for our family. It's not working for me personally. We need to reset. And I think that I have to have that reflection weekly at the moment.
Yeah.
And I think it's about just assessing it in bite-sized pieces. If it's just tonight, why do you feel like you need to work tonight, rather than doing something that looks after yourself? And just make sure that you're making healthy choices in the way that you spend your time. And just because you're not working in the business on that one night doesn't mean you're not working hard.
Yeah. I mean, there's a lot to talk about this. I wanted to just ask you another sort of a small question. Do you prioritize business or mental health, or do you have a preference for, or is it more like, well, it depends on a situation? So, because both are important, but does the business decision influence your personal, or is it like, no, my personal is more important and that will influence my business? What's the, I mean, it's a very difficult one to answer.
It is, but it's also an interesting one that my husband and I have explored a lot recently, because our sort of priority tree is different. So I prioritize myself and my mental health every time, because the business, if it shuts down tomorrow, I'm still here. I still need to be healthy and looked after for what comes next. My husband, who's the technical founder, his identity is so intrinsically linked to the work that he does. And that's what makes him feel fulfilled and happy at the end of the day. So he will often, as a default, prioritize the work that fills his cup and makes him feel good about himself. So that can be great for those priorities, or that can be terrible at coming at it from two different angles. And I think no matter who your co-founder is, I think you need to do that priority tree, and you can do that through, there's plenty of consultants that'll help you do this, that workplace assessment about looking at where your driving forces are, both for, the daily, but also your life goals. We've worked with a handful of wonderful ones in Melbourne, so I've always got recommendations, but you can also, if you're married, we've also done it in counselling. So, there's plenty of ways you can do it. But I think that priority tree, to understand your co-founder or understand the senior management of who's going to be making decisions, because anyone that comes on board at a startup is usually going to be making decisions or making choices on how they spend their time outside of the 9 to 5, and they will also be making sacrifices if they are a founding member of your team. So understanding what their motivations are, how they're going to prioritize things, so that you can also remind them to look after themselves, because you all want to be burnt out at the same time. That would be my recommendation: is work out where you're coming from, work out what your default position is, and work out how to change those habits if you need to.
Priority tree, is that what you said?
Yes. So it's
Love
about
that.
family, money, business, playtime, whatever your hobbies are, whether it's your extended family, if you've got people in your family you need to look after. Everyone's priority tree looks a bit different about what's at the top branches, what's at the bottom branches, and what are the things you really need to do, and what are the things you feel you need to do. And discuss that with who is close with you and who is working in your team, and find out that how you can support them make all the choices that they need to make on where they spend their time, because you can't get it back, particularly when you're making sacrifices around family. You can't get that time back. If your business shuts down in 2 years and you go, do you know what, I spent a whole bunch of my child's life at the desk for a business that no longer exists. Am I happy with those choices? And maybe you are, and that's okay. But really need to be having that big perspective of, am I happy with missing out on this, on these many dinner times, if this business fails. And that's okay if that's a decision you're willing to make, but just make sure you're conscious of it.
Okay with it. Thanks for that. That's very, very useful, and really loved your response to it. And segueing from there into a burnout territory a little bit just with Aprill. I wanted to talk to you now from as a founder and funder. So from that perspective, we know that founders pour everything, just talking to Victoria now, into their startup, and can end up very financially drained if things go south. So what we just spoke about, how do you create financial safeguards to avoid becoming another burnout? How do you sort of, especially if the startup fails, what potentially could you do to to prioritize before you get to that point, which is hard to predict. I know that. I'm very well aware personally.
Yeah, well, I've also been in work and life with the same person. I mean, we recently separated, but that's fine. It's all good. But we're at opposite ends of the risk appetite scale, and I think it's important. Like, we all talk about budgeting at work; it's a function of getting stuff done. I mean, you should be doing it at home as well, and understanding where my risk appetite is compared to Matt's, and he's always had the ambition dialed up high, and I'm much more on the conservative end. I'm not ultra conservative, but I'm up that end. So it's convenient if you have that kind of partnership where you've got one of each, because you've got that moderation sort of built in, and if you can have those conversations around, okay, so at home we know that if we've got a mortgage and there's some equity in the mortgage, okay, what limit are we comfortable with taking a gamble on? If we're going to put some of our own equity into this business, how much of it are we prepared to put at risk? And so having those conversations regularly along the way, because your risk appetite will change from time to time depending on outside circumstances. So having that conversation regularly is absolutely important. And the other thing I would say, just on the emotional burnout, is get a cleaner. If you work together and you live together, get a cleaner, invest in a cleaner at home, because you don't want your leisure time filled up with work, like home work, domestic work. So get rid of what you can, and you can't always afford to do all things, but the cleaner is the absolute bare minimum that I would go with. So that would be my top tip.
Did you hear for mindful cleaning?
Mindful cleaning.
I just invented that. It's the time when you just kind of don't think about anything and just do it automatic.
I do I find vacuuming satisfying because you do get an immediate impact. So there may be things you choose to do.
Good. Thank you so much. Well, believe it or not, come to pretty much end of the session, and this could be, double as long. But if you have any questions, please ask. And now nobody has put any questions so far. I'm very happy to ask anybody or everybody if you have anything specific you wanted to ask. That's something that's happening in your startup life, or just curious about the friend. Happy to do so.
I don't have a question, but I will sort of just as sort of add to what Adrian said before, is that we started taking a salary from day one, but something that we've only just done years into our business is spin out a small part of our product that didn't serve the roadmap and that was not connected. We've purchased that part of the business from the business and have kind of nurtured that as a little safety net for us personally, financially. So just it wasn't something that we, that investment ethos, we weren't enabled to do from day one, but having looked at where the business is and looking at what financial decisions we're making, for us personally, as a family, we knew we needed just like a little bit of something to help us sort of grow that personal wealth. And so that investment thing has really only just become a strategy for us, and I'm sure it will start to grow. But that's sort of 6 years into our business, really, we've just been able to do that. So, that's something that we've employed.
That's excellent, because I was going to ask about the potential maybe spin-offs of the business that you could have, or different products that you might be launching. And now you said that you purchase back and then you treating it as a separate thing. That's really great to hear, as instead of going somewhere else and purchasing something else.
Yeah, because I think with any product, you're going to end up with things that you really thought were a great part of the roadmap, which now actually no longer serve or no longer some value there. So you don't really want to stop servicing or stop putting energy into it. But there are other ways that you can personally benefit from that, I think.
There's some other advantages, and if you're bootstrapped or you've just taken seed in, basically until you have a board of directors. So so if you've only taken insufficient money to have a board of directors, I'm not sure, and Aprill might be able to comment on where venture debt sits in this, because sort of somewhere in the middle. But let's say you don't have to answer to other people too much. So you've got a co-founder who's related, or husband, wife you can talk to. In my case, I was a solo bootstrap founder, which is ironic because I invest in tech startups, completely opposite. But I never took any money from anybody, and I completely bootstrapped. So what most people don't realize is that we started off in Australia and completely bootstrapped. We developed our own tech in-house, and every dollar I had, I put back into the business, essentially. And I was probably one of the lowest paid employees in the business. I was taking 50K in the days when I was earning more than 100K in IBM, and I just never took the money out. But at the same time, I was already, before we left Australia, a multimillionaire. Why? Because not for the value of the business, although that was probably some intrinsic value, but because I'd used the business to buy real estate. So the very first investment I would say to a founder who's making cash flow, so I know it's a very small percentage, but who's making cash flow after they're paying themselves that living wage, and after you maybe done the things that Victoria's done by investing little side businesses, is to buy, if you're operating out of office, for example, buy the building, buy an investment so your business can now legally and efficiently pay the rent, and you as the founder own it in your name, and you own the building. And I made my first $1 million literally by doing that. I was going to rent a building, then buy a building. I found a building in Kooyong Road. I used the business's money legally to create the deposit, and I didn't have the cash. So how did I do it? Because I had no co-founders or anyone to bother me. I lengthened the time to pay my suppliers out from 30 days to 60 days for up to a year, and I got my clients to pay me in 7 days. And I used that extra 30 days cash flow to use the deposits, and I bought that bloody building at auction. And then when I went and we used that building ourselves and paid ourselves the rent, so that covered the mortgage for those 3 or 4 years. And then when I sold my business, they moved out. The acquirers moved out of the building, and I sold it 4 years later. And I sold that building for literally double what I paid for it with no money. So that's one of those little things that made me $1 million before my business produced any profit.
And how long was that after you purchased? How many years?
Like 4 or 5 years max.
4 or 5. Wow.
I wasn't planning on selling it. It just happened, and what it was, So, and even if I didn't, that would have been, my retirement for the long term right there. So those are the sorts of things that you can do as a founder in your own business that most founders actually don't think about. And as I can't do if you're in a venture-backed startup, because they won't let you. And I'm not sure, Aprill, what your views on that would be if you've provided debt funding to a founder,
and they buy a building.
Yeah. And they buy a building, exactly.
Yeah, check the caveats on use of funds. You might not be allowed to.
Right? Because it all worked out very well.
Yeah. But that's very interesting thinking, Adrian, and opportunity, because when you're a founder and million things are happening and trying to be focused, and time just goes. You don't even know. You just 5 months ago by, and just being able to kind of step out of your business and look at what is that I could do to make this business not just more successful, but how can I be more successful as well on a side of the building business.
You're obsessed with buying a building now.
I know I should have bought a building when I was doing PausFest. Yeah, I had opportunity, missed. But yeah, it's a great chats with you guys. Thank you so much. We're a little bit over 30 minutes, but you guys are so amazing and interesting to talk to, and this is a great topic. Thank you so much.
Yeah, and
Thank you.
I'm Adrian at AngelCube.com. I'm always happy to take questions from people outside of it. So just so you know, thank you.